All right, first off, want to welcome everybody to our first monthly meeting in a couple months. We took last month off because we had the in-person meeting, and want to just thank those of you that participated or attended or both in that. We had, we think, a pretty successful meeting. The feedback's been great. Everybody that I've spoken with has seemed to really enjoy it and got a lot out of it, that it has sparked us to start planning for a 2023 meetup as well. So we think it went well. We want to try to do it again. So thank you for all those that were able to attend, and hopefully those that couldn't will be able to make the next one for us. Some quick announcements to go through as well. First off, I just want to call some reminder attention to some website details for us. First off, wanted to draw people's attention to the calendar that we've now got online. If you go to our website, go to meetings and go to update upcoming meetings is the next section. You'll see a calendar there of all the events that we have scheduled, because there seem to be a lot. We're getting that filled up quickly. Including this week, we've got the meeting tonight. We're really excited about our first deal webinar with the Family Office Club coming up this Wednesday. So we're excited to see that. And then we have a lunch and learn on Friday as well. And I believe there's a mound visit on Saturday that I'm supposed to be hosting that we'll try to get it through. We haven't been able to hit the last couple of Saturdays, unfortunately. There's also other details all the way out through January. So feel free to take a look at that and you'll be online. As we're talking about deal webinars, we've also added, if you haven't seen, a list of open deals that have been presented. If you go to on our website under partners and then the left field or LFI deal webinars, you'll see a list of all the deals that we've done since 2021, I believe. And that would include showing you which deals are still open, which does include one from Accountable Equity and the CDF1 fund that is still open, I believe. And Josh, you can tell me if I'm right or wrong, but I believe EIF closed today, right? Yeah. So we do still have one open active from Accountable Equity, as well as some others that are out there. So feel free to take a look at that. Last couple of reminders, no meeting in December. It's right, our date would pair right after Christmas. So we'll take December off. We'll meet up again in January. It'll be January 23rd. And as a reminder, there is a free offer to left field members for the Family Office Club meetup in Fort Lauderdale in 2 weeks. I know it's pretty late notice at this point, but if anybody is interested in going, there's information floating around out there. Can't make this one. The next one that they have is coming up in March in Los Angeles that we will be attending. If you can make it, Ryan's going to be presenting one day, part of a panel. Jim will be presenting another. I'll be there just messing around, hanging out with Josh probably and that kind of stuff. So, but happy to see anybody that's going to be there. We're actually doing a dinner on Wednesday night, I believe, for any left field members that are there in attendance. So if you are going, get a hold of us, let us know. We'll get you dinner details as well. Outside of that, I think that's it. Josh, I will turn the wheel over to you, my friend. We appreciate it. Appreciate all you've done for left field, all you continue to do for our community. You've been a great advocate for us and helped coach us and mentor us with some of the stuff as we've got things up and rolling, that we really appreciate all you've done to help us get started and rolling as well. So thank you. Thank you for being here tonight as well. And we'll turn it over to you.
And that's a big honor for you to say those kind words. I've definitely been a big fan. Would you mind letting me?
I just did it.
Just did it.
Just
did
thought
it
of it.
right on the spot.
There you go.
I was trying to keep up.
Look at that. He's on our website. Just thinking about it.
I was trying to keep up. I'm like, I want to learn all these things. Meetings, here we are. As a matter of fact, when it comes to the meeting we're doing now, would you mind just when we get a chance changing the title? Because as it gets recorded it slips into the record world, we really want to share this message with everybody. I don't know if you guys can see, that's my family. No, you guys can't see my family in the background. We have, there we go.
There you go.
So for those of you who are not too excited about a slideshow, we'll try to be animated in that little box that we're sitting in on the corner. This is a little bit more of a heartfelt presentation. I plan on just really, I'm going to speak to it at our Learn and Grow event coming up. But you guys gave me a shot to say hello, so we're trying out a nice presentation on you guys, if you don't mind. And it really shares a little bit of my heart on the journey over the last few years, a thought process to a new strategy. We're really grateful for you guys. You said we're helpful to you. I do remember the first. I have it on this slide. I think I was on the second show ever, and I think we were there early on. But we have been very grateful for what you've done for us. 49 of our 320 plus investors are LFI community overlap. I always say we have over 3,000 active learners, but only 320 passive investors. So this was a big honor for me to get Jim and Travis to travel out here, who's, I believe, also part of your community, or at least he loves your community. I know you guys are kind of connected. Jim gave a great talk, and you probably have heard this talk that I'm going to touch on. So, I reflected today when we were putting this PowerPoint together, and I said, why is there nice overlap with LFI and accountable equity? Just probably because of these 5 bullet points. I think you guys talk about a lot of these. I talk about a lot of these, and we talk about a lot of these at the Learn and Grow. I think we all are really attracted to real stuff, assets like real estate, but then people behind the business of real estate is very appealing. I think that's a common thread in most of your deals you promote. Passive investing is key. Most of the members of LFI are interested in being part of something that allows them to have the tax efficiency, the long-term cash flow. And I said it earlier, but I think growing in a real community is an overlap as well. And I was pretty passionate when we started correlating websites today too. I'm like, this is, I love the definition of left field that you guys used, but it's all about community for you, finding people that can mastermind it with a basis of a certain like-mindedness, and you're seeking that financial freedom like we are. Now, this caught my attention. This was new to me at the Learn and Grow. He taught all about community personal finance, our buddy, Mr. Jim Pfeiffer, and these really cool graphics he gave us. And I always say, we never did this cool graphic, so we are thinking of stealing it. But in community, personal community investing, I think he talked a lot about the confidence to make a private investment has to do with how much community kind of dialogue, steel sharpening steel. And of course, having a community gets you access, and it overlaps different networks, and that creates a lot of power. And I thought that was very close to what we're wanting to do. So community personal finance, I thought, was a great concept. Today, we're going to share this journey from flipping to investing for legacy. And I love all types of investing. And Melanie and I, this is how we define the characteristics of flipping, just to get you our mindset when we started doing flipping. And we haven't done as much as others, but we've been able to do it at the house level, the multiple houses, and then in resort level flipping strategies. And now we're moving on to a different strategy. But, I kind of broke it into these 5 things that I think about, a lot of deal prospecting. It's mostly a construction management deal when you're flipping. Potential income fluctuates with the volatility on the pricing. So flipping's awesome until the market shifts like it did now. And I imagine right now flippers are a little nervous, whereas a year ago they would have kept going at full speed. So it does change. As soon as that market changes, your deal pipeline's stuck. But for better or worse, you win a lot of times too. Capitalization is structured with a lot of private investor capital. Sometimes it's hard money private, or friends and family, or an IRA loan, but it's a lot of private money, usually not much institutional support. So it could be up to 100% of the money to do the deal is us private people. And then when it's done, you hope to flip out of it and make 30 to 40%, which is great, and get that capital back. No tax rule efficiency, but boy, I love it. This is how Melanie and I started. That's us with Maggie, who's going to be she operates our Learn and Grows now. She's now 22. That's a cute little house in Steubenville, Ohio. So Steubenville, Ohio is not far from you guys. So I spent a lot of time.
Yeah, nice.
That is Oregon, 1630 Oregon. It actually still looks like that. And Melanie and I designed it, and we fixed it up. Now, we never quite painted the outside because we didn't think you needed that when you're a renter. We were very efficient. We just fixed up the inside. And then later in life, after a little bit of intervening life experiences in the world of marketing and running university marketing and all that kind of cool stuff we did for a while in Europe and everything, we came back to America and got into a different type of flipping. It's $5 to $25 million flipping, and it's definitely different. It's a whole new world, and I loved it. It was exciting to build those buildings. Most of those buildings I was a part of, or the lead on. Not this fancy one in the bottom left. That shouldn't be on here. I only got to project manage a little bit on that. But we built a bunch of houses, and I loved it. But boy, was that scary. It was 100% self-financed, which means private money. And the whole moonshot opportunity was one extremely affluent person buying us out of these. And so then I got excited about hotel stuff years ago, and I'll show you some pictures. But when we started doing private investing with accountable equity, these were my two paradigm teachers. We knew how to flip a building and build it. At some point we learned how to run hotels and build and flip hotels, not selling now, burring them. And I remember finding these guys bigger pockets when we were learning how to let investors participate in what we were doing. Because before 2018, all the capital came from high net worth family offices, one in particular family office. So for me, capital was never an issue. Quality was an issue, doing great work, working hard, performing, all the stuff you and I care about, but never capital. And I thought how interesting. I learned about capital raising from Dave Zook, who's a friend of ours, used to be a guest of mine in our hotels years ago. The Zook family, I know Gideon, his dad, pretty well. I know Jonathan pretty well, and then I know David third or second, I guess, in that line. So anyway, he teaches me about syndication. Then we learn about burring, and I say, "Oh, burring! This is what we should do in the world of hotels." And I said, "What is burring to me? It's about requiring continuous. Go find another deal so you can burr it. It's a lot of construction management because you're buying on value, which means you're paying the price for a dilapidated thing. You got to do a lot of construction. Then its potential income fluctuates with the market volatility based on the appraised value at project completion because you got to get a new loan, of course. And then capitalization, it's probably very high private investor capital for a house." And I put both of these pictures up because back in 2018, if you knew me, you would have heard me speaking a lot with at that point, helped me get off the ground and still beloved friend, Matt Faircloth. So he helped get me into business with raising capital. And I called him the burr guy for apartments. And because at the time, everybody was talking about burring houses. And at the time, Brandon Turner was only really talking about burring houses back then. It wasn't until his epiphany a few years later with what he does now. But Matt was one of his teachers of that. So anyway, really cool, great, can be great for tax efficiency. You do require a new expertise. You need to become a multifamily manager, or you need to learn how to choose a manager. But the management is where the money's made. You have to make good management to make money is what I mean. So from my lens at that time, when I heard, okay, burring houses, which is kind of what Melanie and I did for about 5 years, 10 years on one house. So then I'm sitting here, I had this experience, if people know me, this is where I started my first concept of hotel burring. And you have some before and afters of each little space there. And we took something from the 70s to the 2000s and kept a retro vibe. It did really well. So then we did a second one, all with private capital from a family office, and went from okay looking to really, really nice at the bottom. So then eventually we find Renault, and I'm using this as a case study for my own journey into a new type of investing. So this was a drawing. That drawing on the right is what we paid somebody to do in early 2018, mid 18. No investors yet. We said, what if we could draw Renault to make it look like that? Because on the left is what it looked like. It was not good. And I said, well, if we make it pretty and refinance it, it'll be great. But a lot has transpired, and Steve Sue knows, and some of you guys who've been with me know, a ton has transpired since 2018. Some good, some really tough. And I remember people tend to want to know where you fail and what's been hard, especially in the world of private investing. They just want to get right to it. What's been hard? Well, there's been a lot of hard, and Renault has been the journey of tough. At the same time, it's like having children. That's tough too, but it just has always been very rewarding. Melanie and I go between crying and laughing all the time when we think about this. There's a lot of really beautiful things happening, but to get from that ugly structure to where we are today sounds like a construction project. But I'm going to share with you in this quick presentation, it's actually a journey of our heart. We've kind of changed. And one of the things that's, there's a lot going on. We have this whole culture program that we're trying to teach people how to love our guests and to treat them with dignity. There's a whole lot of stuff going on the actual day-to-day operations. But the journey to restore something this old and the confidence that it's going to be here beyond us has kind of changed us to legacy asset investors. And so, of course, we've recently done it again with many of you at Kent, and this one is where I'll be tomorrow. I'll be at that beautiful property tomorrow, and there's a lot of cool stuff happening there. But boy, again, very tough. So I said, well, if you were to ask me to define legacy asset investing in this metamorphosis, up at the top, it talks about like how family offices think. It's fun that you guys know my buddy Richard C. Wilson, and he always has that C in there. He's been on the podcast a lot. I always make jokes. He's our keynote speaker this week. If you want to fly out and be with him at Learning Grow, he'll be here this week. Steve, he'll be here Friday night. There's a big press event. We're very fun night. And then Saturday he'll speak 2 times to our investors who come. But this to me is what has happened. Accountable Equity continues to seek to be and foster a learning mindset. So this learning mindset means that we've developed this asset as we developed Renault. And then as we took on Kent, we discovered we had moved from BRRRR strategy to what we now call legacy asset investment strategy. And these are the hallmarks that kind of come out of my mind and heart right off the bat. Like if you were to ask me, well, what's the difference? Well, investors become founders. They're now part of something that's going to be here for definitely to the well beyond their life. And so when you have something that's going to operate and greet people for hundreds of years, you tend to fall into this category of founder, co-founder, even though we're restoring it. And then ownership becomes more like stewardship. You're actually going to pass it on, even though we don't plan on flipping it right away. Someday someone else will have it. Value add is becoming reviving and reimagining for us. It's not, for us, value add here wasn't just as good as saying, well, shouldn't we upgrade the bathrooms and the kitchens? It was more like, how does that fit into the overall next 100 years? Plus, what are we doing for income while you have a pretty room? What are we doing to make them have a good time? And then the exit strategy here has shifted to this generational wealth building. So we've recognized that our investors have joined us at different times. And the reason I was grateful that Chad invited me to speak tonight is 2 reasons. One, Chad has given me a lot of advice over the years. I've not finished all my homework on his coaching. He's going to help me coach into designing like long-term employment incentive programs, which is one of his gifts. But he's also, he's part of LFI, and LFI has been very generous to us, and we've been grateful to all the teammates there and the friends and family we've made. So, but the other thing is this presentation, it allowed me to crystallize some things I've been saying in conversations, and I wanted to get it in writing. So thank you, because generational wealth building is the opposite of get rich quick. I gotta write that down. I should write that right now. What is generational wealth building? In a phrase, it's the opposite of get rich quick. And let's talk about what else it means. It does mean that you guys who are partners with us, I think you guys have pride of ownership, which is your pride of foundership. We get investor visits almost every week. I always feel bad. Sometimes, there's investors that come all the time and they're out having fun, and I see them and it's very casual interaction. Then there's investors like this past week, a gentleman who invested 3 years ago. I've never met him except for a phone call 3 years ago, and he flies all the way out. And I wanted to spend all day with him, but I couldn't spend all day, So it's kind of an interesting contrast. You have the people that come a lot, you have the people that fly in once a year, but it's a gift. And when they get there, I think they have pride of ownership, and we're honored about that. These things that are legacy based tend to get a little more press and have a little more traction in the community, which is great. So to compare, we did flipping, had 5 of these, burring had 6 of these, and then I think the pros and cons is legacy has a few more steps, and good and bad, right? There's some struggles in the complexity, but there's some peace of mind in the complexity too. Like Warren Buffett says, it does build a little bit of a moat around you, because what we're building is not easy to do. You can't replicate it in a weekend. So strategic, the deal prospecting is different for us. I've come to realize, we looked at it like hotel burring or apartment burring, which is let's have brokers just bring us deals. Well, for us, it's now becoming more methodical. Where are we going to invest more time and energy? Where are we going to build another epicenter of our team? So it's very strategic. It's heavy duty construction management though. That is the same for all 3 strategies. Here though, I would say a little difference is every time we bolt another thing to the building, we're not thinking it's there for 10 years. We're thinking it's there for 30 years, maybe longer. So we do tend to lean towards quality, which is something we've come to realize. We're definitely not flipping these things, right? So you can't give over your problems to the next family. It's us. So the business plans have to be designed that maximize revenue streams. That's another thing we've learned about legacy assets. They're complex, but they have revenue behind that complexity, meaning you can create new things. And this has kind of helped us metamorphosize what we're going to build and buy. The value of the market is still the same issue. You still have volatility. And the pros and cons we've experienced are we're not trying to cash this thing out and sell it tomorrow. So whether or not the market's tighter or looser doesn't exactly impact our investors today. We're not trying to sell it. It does impact us for debt security, right? We have to get debt, and when the interest rates goes up, it is impacting our ability to burr out and give our investors money. So you have to trade off. Well, we have a great business. We just have to be a little more long-term horizon. So that kind of metamorphosis has happened over time to us. Capitalization is a little different. Where you're buying a flip, it's usually a private loan or a family loan or your money, 100%. Here, we were able to put debt on these legacy assets, but we did need to raise 30 to 40% of the capital. Why? Because you're buying things that aren't performing and you're going to make them perform. So it can't be 10%. It can't be 20%. It has to be more. You have to be aware. And there's a reason why resorts are either mega resorts, like anything in the world of like the mega branded ones, are usually institutional money with long horizons of repayment, or they're wealthy families. Family offices own a lot of beautiful resorts like what we do. And then, of course, at the lowest end, it's a family running out of money, which is who we're trying to help. We're trying to buy their properties. But it's not 10%. You're going to need to put capital in, because as you're turning a legacy asset around, they do need startup capital, right? So that's been a metamorphosis. At first, we tried to capitalize this with 20%. Well, no, we needed to put more into it. But at the end, we think we can get it down to the 20% invested capital after refinances over time. And then tax efficiency is incredible with these. I would say we're at the peak of real estate tax efficiency because of lots of equipment, lots of things that do depreciate. You do have that on an annual basis. There's replacement. So you should always have a good balancing depreciation. Of course, we're in the early stages of these where it's been surplus depreciation. So our investors have had bonus beyond even the payments we make them, beyond that. Teamwork is number 7. And this is something that the bankers have been teaching me. So again, I appreciate all my investors, and I really want to get to know them as much as we can. That's why we do in-person investments. But number 7 has been the most compelling part of the year 2022, is that the lenders also and outsiders look for continuity between the investor group and the operational group, because with these types of, let's call them more complex legacy investments, you need that kind of lockstep. And I feel like that's why we do what we do. I think that's what we're trying to create here. So as a case study, lots of this you guys know, so I'm going to flip through. We're out on the East Coast. This is one of the interesting problems of this metamorphosis for me. Originally, those ratios of capitalization were based on the Burr concept, where you put as little in as you can, you do as little as you can to make new cash, get a new appraisal, pull all the money out, boom, everything's great. Well, in that period of time, something good and bad happened. We grew quick, even with the pandemic. Well, the problem with growing, think of it this way. If we knew we would be as big as we are today, we would have raised twice as much money. That would have been the right ratio. And so as we've metamorphosized our business plans from Burring to legacy, we're now in this stage of reevaluating our capital structure. And should we have raised more? Yes, we should have doubled the equity raise. But who would have known in 2018? Well, now we know. So when we go into new projects, we double the capital raise from the ratio that we raised at Renault was half as much as the ratios we're going to raise going forward, because we now know our model overlay works and it works quickly. So you have to capitalize the growth. So, for example, you take a look at this and you just see numbers. Richard C. Wilson's always, he's like, that's staggering. I'm like, yeah, it's kind of staggering, the change in revenue. And you think, well, revenue's good. And people are like, why do you focus so much on revenue? Why not the whole P&L? I said, well, we're still not even at the top revenue number yet. Next year's budget is almost 24 plus million. And we've already secured the majority of the contracts already to get us there. So 23 is looking unbelievable. So you're like, well, is that good or bad? Well, it means you're going to have to change your fixed structure cost. And as you change your fixed structure costs, whether it be new executives or new operational processes, you have to invest a little more. And this has been the journey. Whereas that gray line, it gives you an example. You take a look at case study 4, this is when the metamorphosis started to happen. We still haven't really figured this one out yet, meaning like where will it appraise at when we're done? Will it be 60 million? And what should we have raised if it's really a $60 million operating business? We should have raised a lot more than 10 million, I'll tell you. So 11 million at this point. So we're evaluating, where are we in the story? Are we finished growing at Renault? And if we are, then I guess we don't allow any more revenue growth, because that would cause more operational investment. And we're saying, or is the right choice to finish the legacy? And if we finish the legacy, we need to be in alignment with our investors. And there's a lot here I want to talk to you guys about. And this is what I talk about. I don't know why that was last year. Sorry. So for us, it's about hiring people to fulfill that legacy. And this is part of what I show everybody, with the servant leadership model, the people on the bottom are actually more important than the people on the top. The bottom row have upwards of 50 to 75 staff, some of them. Milani has about 25, but Carmen probably has also about 30. Joe has probably 75 to 125 in season. Catherine's an office teammate with me. Kevin can fluctuate between 50 to 110, depending what season. Michael has a ton. He runs all the restaurants. He probably has about 75. So you add it all up in a given peak month, we write the most we've ever written was 373 personal paychecks, in one pay period. So that's a lot of people at different times of the year. So these guys are serving that frontline teammate, and that's why we all try to pour into the teams. These people are helping us make the decisions. There's a whole fleet of specialists behind the scenes that aren't necessarily on payroll. We have a head of the person who's done $1 billion worth of private real estate deals. He helps me do the fund management from the inner workings. His name's Chris Galligan. Then we have a guy named Brian Fitzpatrick, who's ran in the East Coast largest catering company, which we didn't realize we're going to probably eclipse eventually. So he's helping me navigate rapid growth in a sector that, to us, it was originally tangential, but has become core to our business. So I think why I shared all that with you was to basically, you guys have done me a great gift. And I'd love to just stop there and take questions if you have any.
Great.
Let me see how to stop the screen share.
Josh, we appreciate that. So yeah, if anybody has any questions for Josh, feel free to unmute and ask, or type it in the chat and we can read it off, make sure Josh can speak to it and so forth. But interesting. I mean, I think this speaks to how agile you've been throughout your entire career, really, if you look back through everything, and pivot at the right times. And you seem to be at another good pivot point that, you're taking stock of what it looks like for the future and trying to calibrate and get set up. That's great.
And, I think for you guys, as you're thinking about it, for your own lives, and maybe that's a nice way to transition this presentation to your life. For us, I think in general, I think we all love the BRRRR strategy. So I think most of us have asset classes that can probably benefit from what is a really great strategy, which is to have your capital come out relatively smoothly and then keep it. And we want that too. We're at this question of like, what does it look like to build a portfolio? What's the opportunistic? Maybe that's where you guys are at too. What does it look like when your portfolio gets a little bigger? I don't know. Most of the left field investors are actually a lot of them are probably active investors. They do the management themselves. Chad, what do you think?
We got a little mixed bag of about everything, it seems like, these days, which is great. I mean, that's what we like, is the diversity in the community, so that you can pressure test against several scenarios as things come up in our forum and so forth. So it's hard to pinpoint one thing anymore with our group, which is a good thing.
Yeah, it's an interesting. How big would you say the group is
now? We're around 1,200 now altogether in the community, and so yeah,
pretty active community too.
It's a laser focused, group of like-minded people. So at least it's trimmed a lot of the noise off the edge and really has a lot of people pointing the same direction with this to get educated. So it's been quite the journey. It's been fun, just like your own,
What else can I do to add value for this session? Or do you have any questions you wanted to ask me? Or
yeah, anything from the community? Anybody's got any? I guess, Josh, as I'm hearing all this, I always think in terms of the limited partner investor, of like, well, what does this mean to me if as I'm investing in future deals with accountable equity? How does this look any different than what we've been looking at with you over the past few years?
I'm glad you asked that. I mean,
I get very nuts and bolts. Sorry.
I want you to ask that. I mean, I think what we're contemplating of announcing on Saturday, so you guys are going to hear it earlier. First of all, Drew, I am so sorry to tell you that we have not finalized the dates for Learn and Grow 23. I do know we're moving, our Learn and Grow experience. Steve's been to some early ones. They're now off the charts. We know people travel in from the West Coast sometimes. So we've been, we as Accountable Equity, we pay for that. We underwrite that to the resort. And so it's expensive. And so what we're doing to be conscious is we're probably going to do 2 next year that are the normal model. And then we're probably going to do a golf outing at each property, which is a similar kind of style, but it'll primarily be more for fellowship, right? So 2 of the 4 will all be there still. The idea of Learn and Grow is you get to meet the team and dialogue with each other and us. So we'll do 2 that are a little less impact on the cost structure for us, which will be golf outings. And then 2 will be these full-scale, high-quality, structured events. So that's the only reason I don't have the answer. But we'll probably have 1 at every property. So if we have 3 right now, we'll hit Kent, we'll hit Renault, we'll do a golf outing in Renault. We'll do hopefully a Kent project. Hopefully we can do a Kent early Then we can do a golf outing at Renault. Then we can do a summer LBI if possible. And then we can do a winter wonderland, vintner wonderland at Renault full one again. So a year from now, probably this week will be the last one of the year. The other three we'll figure out, and I do owe it to you, Drew. Before the end of this month, you'll have all of next year. But Chad, let me answer that question directly. We're going to seek to give options to our investors that joined us during this metamorphosis, and we're going to recognize the values that they need. So, for example, our hope in 2018, when markets were stable and I could walk into any bank and get a stabilized mortgage for a resort, which it's not that way right now. I pursue bank structures. I have a lot of Ohio banks that I'm talking to, ironically. There's a whole credit union association that's talking to me, Joe Bejas. I could introduce you. He's a cool guy. Then we have a group of more regional here, and then we have the USDA. So we have three different types of lenders right now we're working with. We will be putting a new debt on next year, which means we're not going to be able to refi out and give you back all your money. So what we're going to do is we do always work with a large capital reserve because we're a big company. We're going to seek to let investors choose. Would they like to stay getting their preference and be investors for the long haul? We're going to miss the goal of hitting a refi in 5 years. So knowing that, we're going to offer some investors the chance to be redeemed. It'll be their option. If they really want their 100 grand back right now and to make all that 8% preference they've always gotten, we'll catch them up and pay them back their redemption, and we'll delete that equity, okay? We're not allowed to sell each other's equity because that's called securities trading. That's against the law. So that would be what is called a redemption. The investor will have been made whole, made some money. They don't get to be part of the upside eventually, but they've made their money and we've honored at least our promise. The new investors we bring in will now know we're more this way, right? Which is a long-term cash flow play, seeking the right time to get refied or other opportunities for equity recapitalization, but we have to do what the business is telling us. That's kind of our legacy strategy, which means new people can join us. So we will allow new people to join us in 23 for all properties. And the basic thought is we're going to go to market with a package that says, guys, ladies, we now have the full picture of growth that's still coming. If you believe in that growth, if you want to come see it for yourself, you can buy in. You'll have to pay more for the equity. So I believe Steve Sue joined us, I think, when it was still $1 for equity. One unit was $1. In the future, it won't be $1 anymore because now you're getting cash flow first year. So it'll be more than $1 for that equity. But that'll allow for some arbitrage. So as you reduce the old investors that want to go and you judiciously allow new investors, you'll actually have less equity out there or parity, but it won't actually be a big dilutive nature. And our thought process is we will hopefully get to that proper capitalization through organic choices. You know, we still sit on, people who know us real well know that we're sold out. You can't be in our hotel. I just tried to book a room for this month. You can only come Tuesdays and Wednesdays. You know, it's like amazing. It's a good problem. There's a few late December dates you could still get, but that's how it is all the time, which means we turn away so much money. So there is opportunity to add rooms. We are still seeking that. Who knows if I get that done in time for the future, but we are also seeking ways to capitalize on our neighboring hotels. Been more tricky than I thought it was going to be. Trying to take money in a fee since we're filling them, you know, and that's hard for hoteliers to seem to understand, but we're going to work on that next year. So I think I answered it. Some people offered to be redeemed, other people will be invited in.
Great. Thank you for that. Any other questions?
Yeah, hey, Josh, I certainly appreciate the presentation, and I've enjoyed being one of your investors. And yeah, I appreciate the legacy slant on this, because a lot of these past investments we do are could be, you know, they pencil out as a 5-year hold, but they end up selling in 3 years or whatever. So you know, it's nice refreshing, I guess, to see that you're trying to go down this avenue because when one of your apartments that you've invested in sells, now you got to find another one to replace that. So I mean, yeah, maybe you got your money back and you got some back end profit, but I certainly appreciate this model, and that's why I'm a big fan of accountable equity.
We're a big fan of you. Thank you for all your support, and it means a lot. And Steve, what you just said has become clear to me. So they're probably out of 320 investors. I sadly don't know everybody. I mean, I would like to know them. That's why we do learning grows, and we kill ourselves to make sure our staff puts them on and tries to do a nice job. We always beg our investors, please come, because how else are we going to be able to break bread together, you know? But there may be people who are like, we'd like to have our money back. And what I'm excited about is creating a mechanism using working capital, putting people on a waiting list, say, hey, I do want to sell I want to redeem it. It's called redeeming. I want to follow the rules in the operating agreement. I want to redeem my equity. I can't do it for everybody in one day, but I can probably judiciously do it over month after month after month. And maybe it's only 50 people out of 320. It's probably not everybody, Steve, because a lot of people have fallen in love with the idea of perpetually owning this. So most people are probably where my heart is, which it seems like maybe your heart is there. And we do need that alignment. You know, we need alignment with our investors. And so I just want to be more and more honest about that. And I appreciate you guys letting me practice. Thank you.
Absolutely. What other questions? I think we got a post-turkey coma going on in the group tonight.
Don't worry about
very engaged group.
You guys are great.
Any other questions? Well, we got the man, the myth, the legend on the phone with us here.
Anybody who can drive out to see us, come on. We're doing if you really need a comp ticket, I'll get you a comp ticket. We have about 100 people coming this Saturday, which is a big one. We have kids activities. If you're in the region, anywhere, you should come down and hang out with Richard C. Wilson and the rest of the Accountable Equity team, even if you're not an investor. We'd love to let you see what we do.
Great. We appreciate that, Josh.
Thank you, guys.
Yeah, I've been to the Learn and Grow twice, last September and then the September of 2021, and it's a great event. And the food, by the way, was just off the charts. It was fantastic. Your new chef just done a great job with the food, and I mean, no wonder you guys are selling winnings so well over there, and in addition to your beautiful facilities. But but the Learn and Grow is a great experience, and you meet other passive investors, and it's been a great experience for me to be there and actually to see the asset that I am an investor in, to see how it's growing and how it's improving.
Thank you, buddy. And Jing Johnson, the terms it'll be something like what I just described, and we're going to either ask our CPA to help us value the unit, but it'll have to be more than about $2 per unit instead of $1, at least for it to be equitable to allow new investors to come in. But what's interesting about the model is it'll come with a preference payment, right? So say you buy in at a certain number and it's worth 8% preference. Even though your equity you're paying $2 for, you're still going to earn on the dollar value at 8%. Your long-term hold strategy will have cost you slightly more than it cost the person 4 years ago. But the person 4 years ago, if anybody's on this call, they purchased a very difficult project, and they deserve whatever upside they get. It was amazing. They deserve a lot of credit because we weren't making money at the time, and we now do. So thank God. It's something like that. New Jersey state income taxes scare me. Isn't it irrelevant to you for that? I mean, I don't know, Steve. Do you have to pay any New Jersey income taxes on the K-1 we give you? No.
I don't think I have.
No.
All right.
So does that answer your question, Sean? Sean says New Jersey state income taxes scare me. Yeah, we agree. I personally actually don't live in New Jersey. I get to. The funny thing about New Jersey is I've done almost 15 years of my life in New Jersey, and I've never lived in New Jersey. But all the projects I've done have been in New Jersey. So I have a good database here. We have hundreds of thousands of guests that open our email. So we do actually plan on buying more projects nearby our current projects over time. Though New Jersey's not necessarily the best place to buy a multifamily, it might be a good place to do what we do. Um, we primarily base our revenues off weddings, and this is the second most expensive state for the guest to have a wedding. So it allows us to build margin into our prices to allow profitability for investors. So the pros and cons of Renault are it's extremely wealthy in New Jersey. So thank God that when they pay us $42,000 for 5 hours of an open bar and some delicious food, that's actually considered affordable. Whereas me growing up humble, that sounds crazy to me. So
it's not Steubenville, Ohio,
Yeah.
kind of.
yeah, so it allows for margin, but you don't have to worry about income tax from us.
Go ahead,
So
Sean.
I hear what you're saying. I think you know, you're obviously not paying state income tax on your K1s on a yearly basis, but eventually the tax man will come, right?
You mean if you yeah, I mean, I think about that.
Either
we pay real estate taxes. That's somewhat mitigated by our agriculture, but we pay a pretty good sized tax, which is embedded in our our income statements. What else would you like me to answer about that? I don't know if I have any other comments.
I think you covered it. Thanks.
Yeah, actually, I did pull up my K1 from you guys, and I had a negative number in there, so that's why I didn't pay anything. But I did have a New Jersey, looks like a state of New Jersey partner share of income return.
Yeah, I wouldn't expect you to have to pay on an annual basis. I guess likely when you'd pay would be after a very long hold or upon exit, right? That would be my expectation.
Great
and then
question.
if you're paying like 13% or whatever it is.
I'm going to look into it because honestly, it's never even been a question because of the strategy of just the K1 distribution. And then, no, I will look into that, Sean. It's a great question.
And in the legacy model now, if you're not really going to sell anytime soon, that maybe defers that off that much further too. So.
It probably does, but the way I think of what's the future for us, so it's 10, 15 years. We now have multiple resorts, which one cool thing about building a legacy portfolio strategy is maybe Steve doesn't invest in the next resort, but each resort, because they're going to become considered part of the Viva May, and who knows that what will happen is banks will actually give us higher valuations when they look at all the properties. So it's called compressed capitalization because of a portfolio. So we're all going to hopefully benefit on our real estate valuations because if we can replicate the model, they're actually going to give us more valuation. And eventually, does this company, to create even more liquidity for investors, we are exploring like what happens when we have many of them. It's not going to happen tomorrow, but over time it will. We'll have many of them, and we're going to always wonder how to best provide for the investors and to keep the promise we made. Is it through institutional investor buying in, and then that creates a high valuation? We get a liquidity event, but we get to keep peace. So I do share with people, like for right now, it's got a long runway the way it is. Is there a time where somebody larger than us comes in and buys a portion, gives us all an opportunity for some tax deferred or tax strategic equity distribution or even debt redistribution? We do keep our minds open to that because what we're sitting on here could be a gold mine that hasn't even started yet. For example, we have land development rights that are owned by the investors. We'll see what happens as we do that. We have an intellectual property rights on the Champagne name. We haven't sold that to anybody. Those are the types of things that we think eventually will be some windfalls in the business plan that we do not budget for. They're just going to be found money for all of us. But anyway, so is the operational complexity of a legacy investment a positive or a negative passive for a factor for a passive investor? Stan, that is the 100% right question to ask. So Stan writes, is the operational complexity of a legacy investment a positive or a negative factor for passive investors? And I would say it makes it definitively passive. There's like no real easy way for you to get involved. So you will always be passive. I don't know if that's one way to answer it. It is a negative and a positive, right? So the negative is it is not easy to I can't just go hire another management company and have them take it over. That's why my personal guarantee is on everything, right? So there's 100% alignment. If I'm not a good operator, then I'm losing everything. So I think that's a good alignment for you. Whereas as sometimes larger scale syndicators, like some of the ones I've seen on this channel, you guys have some real small ones, but then you have some real mega ones. The mega ones probably don't have a single personal guarantee on anything. So they're probably doing a great job, and that's fine. Well, for me, everything is tied in. So you should take that as a bit of confidence that we're never going to give up. But yes, it has some negatives too. It means we have to hire expensive staff. We do deal with inflation. We fight it, and you really are betting on a team of people, which goes back to 4 years ago when we started these learn and grows. We always started whenever an investor would call me out of the blue and say, tell me all the stats and I want to know everything. I'd say, hold on, time out. Great news. We'll go through anything you want. You get a full financial review every year. None of that's worth it if you don't want to work with us as people. So I encourage you to come visit. Don't send us any money. Get to know us through webinars if you can't travel. So the answer is we are people capital, human capital dependent. And if you consider that a good, then this is a great good. It is a bit of a moat. So that's a tremendous good, meaning you can't usually do what we do. So the better we get at it for you investors, the better your investment is going to become, and it's not easily replaced like a Hampton Inn. So say you bought the world's best Hampton Inn and it was on the side of the road in Nashville, you're as vulnerable as the next Hampton Inn that comes in the next month. Still might be a great investment, but there's no moat. So is complexity good? It creates a good moat. It allows us to charge more price. But is it bad? Yeah, it's bad. It has human complexity. So for you, Stan, it'll be your choice, and whether it's good or bad. That's the way I answer that whenever somebody calls me. And by the way, I think for most projects, you really want to get to know the operators on some level and get to understand their DNA. They're not perfect. We're not perfect. It's mostly a commitment to invest in us. And over time, we want to earn your trust. That's why we do these face-to-face things. Mr. Trotter, good to see you, buddy. I love when people show up on the screen. It's nice. It's very kind of you.
Yeah, I've been really enjoying this. I'm glad I carved out time. I enjoyed the open and honest forum, as a discussion here. I don't really have any, well, I do have a question here. Well, first of all, I've enjoyed the updates, the whole by whole updates that you guys have been sharing on the social media. That really gets me geeked. Sadly, I'm a very poor golfer. So I was wondering, as an investor at LBI National, if we would have access to a course pro that would teach us how to golf without without multi-syllable strings of profanity. That's what I think I would want as an investor. So
that's a great idea. See, at LBI National, that is a really high-end premium public course. Whereas Renault's a great course, a nice course. It's a full championship level. Yeah. But Sea Oaks, which is now LBI National, was built at a higher level. More complexity. You actually have to be a better golfer to play there, so it's not my favorite.
Well, that's not going to bode well for me. But
whereas Renault actually is beautiful and plays well, so you might want to practice more. But anyway, we have a wonderful pro. He's been a golf pro trainer for like 30 years that we inherited, and I love him. He taught my kids and I for an hour, and I was like, man, this guy's awesome. So maybe if we do a golf outing, Mike, which I will be doing, we could have the people that are actually going to play and the people that want to learn from this great guy.
Okay. I might fly across the country for that. So there we go.
Set Mike up with the simulator just to be safe.
I'm not kidding. That is a really, I'm really
in a soundproof chamber, Chad.
Soundproof chamber. Put him in a closet down in the basement by himself. Tell him it's a simulator. He'll be fine.
Pro lessons. I think that'll be a lot of fun. We could do like first come, first serve line sign up. And while I think we'll
there you go. The brainstorming continues. Good stuff.
There you go. Oh, it's a working meeting.
Yes, yeah. Well, Josh, I
write it
want
off.
to be cognizant of the time and not drag you over here too much, but we really appreciate you coming on and sharing this new direction. It's really exciting. Sounds like a great opportunity. People that are interested, reach out to Josh, touch base, see if it's the right thing for you. So, but we appreciate you coming on and sharing.
We appreciate you guys. Thanks for letting me say hello to you guys. Thanks for letting me work out my new presentation. Thank you so much.
Absolutely. Absolutely. Cool. And for those of you that are on, and Josh, you're welcome to stay on for this if you'd like to, but we kick it over to wonderme.com usually after this to do some networking. Steve, I'll kick it to you if you don't mind introducing. And
yeah, I just put the link on right there, the post-meeting networking. There's a link right there. The password is capital LFI 22. And if you guys want to head on over there, make sure you shut down your Zoom as well, because otherwise you might get some feedback. So if you guys want to do some networking for the next half an hour or so or whatever, I'll be on there for about that long. And then when you get onto the site, it asks to take your picture, and then you can move your little icon around the screen. If you see a person by themselves, you can introduce yourself. Just get up close to them, and you'll make a little circle. And you may see, we may just be one big circle. I'm not sure. So if you want to just go over there, click on the link, and then we'll see you on the other side.
Thanks, Steve. Thank you everybody for attending. Hopefully we'll see you over in the networking session next. Other than that, we'll see you in January again.
Yep. All right.
Thanks all.
Steve.
Okay.